Welcome to Unit 3.3, where we will explore the essential concepts of costs and revenues in business. Revenue is the money received from customers, calculated as price times quantity. When revenues exceed costs, a business earns a profit. Conversely, if revenues are less than costs, the business incurs a loss. This fundamental relationship is key to financial success. Our first learning outcome is to understand fixed, variable, direct, and indirect costs. Fixed costs are expenses that a business must pay regardless of its output or sales. These costs remain constant even if the business produces nothing, such as rent on a building or interest on a loan. Managing fixed costs is crucial for financial stability. For instance, a business must pay $5,000 in fixed costs regardless of its production level. While fixed costs can change, they do so independently of output levels, such as when a manager gets a raise or rent increases. Variable costs change in direct proportion to the level of output or sales. For example, the cost of raw materials increases as more products are made. Understanding variable costs helps in predicting expenses and setting prices. Total cost is the sum of total variable costs and total fixed costs. The difference between total cost and total variable cost is the value of total fixed cost, which must be paid regardless of output. This calculation is essential for budgeting and financial planning. Let's apply our understanding of business costs through an assignment. Calculate the total costs and average costs per unit based on different output levels. This exercise will help solidify your grasp of cost management. Here are the calculated business costs for various output levels. Notice how total fixed costs remain constant while total variable costs change with output. This table illustrates the importance of managing both types of costs effectively. Direct costs are expenses that can be clearly identified with each unit of production. These costs can be allocated to specific cost centers, such as wages and materials. Understanding direct costs is crucial for accurate product pricing. Indirect costs, also known as overhead, cannot be directly related to the level of output of any single product. Examples include rent, advertising, and utilities. Managing indirect costs is essential for overall financial health. Our next learning outcome is to understand revenue streams. Revenue is the proceeds coming into a business, usually from the sale of goods or services. It's often referred to as sales revenue or sales turnover. For example, if a shoe store sells 100 pairs at $60 each, the total revenue is $6,000. Revenue can also come from sources other than the sale of goods or services. These additional revenue streams can significantly impact the financial stability and growth potential of a business. Subsidies are financial aid provided by the government to benefit society. For example, farmers may receive subsidies to stabilize food prices, or steel companies may get funds for defense purposes. Subsidies help lower prices for customers. Grants are funds given by the government to specific companies for particular reasons, such as supporting new businesses or aiding companies in economically challenged areas. These grants are vital for fostering economic growth and innovation. Sponsorships involve one company giving cash or products to another in exchange for displaying their name, brand, or logo. This form of external finance helps businesses gain visibility and build brand recognition. Donations are financial gifts that may or may not have strings attached. While not common for businesses, donations are typically received by charities, schools, hospitals, and universities. They play a crucial role in supporting these institutions.